Mona, it's always good to have you here on the show. This morning, we've got stocks a little bit lower, dollars a tiny bit firmer, as we were just talking about. It seems the question we should be asking is, what with stimulus is already understood by the market? What's your view on this, Mona? If we get, let's say, the $1 trillion, $900 billion that's been floating around, is that an incrementally surprising new catalyst for the market?
Yeah, thanks, Oliver. And look, I think absolutely, if we do get a deal before the Christmas holidays, and the hope is really that something comes together over the next 10 days or so, I do think that would be actually potentially more upside for this market right now. I think right now we're in this period of wait and see, of uncertainty, but this is an economy, at least, that really does need this additional stimulus to get us through this period until the vaccines really arrive in earnest. So certainly I think the market is hopeful for that. We remain hopeful that something can happen. If it doesn't happen before the Christmas holidays, we certainly expect it to happen after January 20th. So I think in the near term, keep in mind we may see a little bit of sideways movement, but if we do get better news on the stimulus front or better news on the vaccine front, I think we'll see this market continue to perform.
Mona, what does it mean for bonds? What does it mean for the dollar as we look to some of these assets that have been trending now for several months? The dollar obviously has been trending low for some time. We kind of went through this phase where the dollar was moving sideways, then it broke. What, in your mind, is the best kind of explanation for that? I mean, to me, that kind of looks like there's already was something new the market was processing, the odds of stimulus, something. I mean, we had a couple month range for the dollar, and then we kind of snapped lower, and we've been there since. What was the cause of that, if not the stimulus kind of getting understood by the market?
Yeah, absolutely. Look, I think this is a market that is pricing in a global recovery next year. And so in the scenario, or in historically when the global market and the global economy starts to perform again, the dollar does tend to come off. And we're starting to see that. So clearly the markets are pricing in not only this global recovery, but a cyclical recovery. And so dollar softness, we've seen, as you spoke earlier, the copper trade has really taken off, another indicator of an industrial recovery. And of course, when you look at equity markets, you're seeing over this last quarter, or at least quarter to date, really the sectors that have driven this market have been those value cyclical sectors, areas like financials, energy, industrials. And I think, markets across asset classes are showing similar trends. So, we've always kind of said as that vaccine news would come on board, markets would start to price in pretty quickly what happens over the next 6 to 12 months. And I think that's what we're starting to see today. So the dollar is part of that story. Certainly rising treasury yields are part of that story. Perhaps gold as an inflation hedge, part of that story. And then, of course, this rotation in fixed income and in equity markets towards more cyclical sectors, part of that story as well.
Mona, if we have this deal that is able to keep pushing the dollar lower, what does that mean for bonds and those who are thinking about the possibility of inflation? We've had bond yields climbing since August, even in a period again where the dollar was kind of going sideways. The dollar breaks down, and that's now been moving with yields higher. So for the most part, dollar lower has been with yields higher. If we consider the gold trade, it's been fairly, depressed over the last couple months. Gold trending downwards. We got a little bit of a bounce as the dollar broke lower the last couple weeks. But it seems like this idea of inflation still has proving to do, at least for gold. But for bonds, it's now has a different trend. These bonds have been climbing in yield for several months. So what's kind of going to be that incremental driving force, and how does stimulus play into what's happening in bonds?
Yeah, absolutely. I think generally we have some of the ingredients in place for an inflationary environment to take place over the next 6 to 12 months. We certainly have the Fed still on the sidelines. They are holding rates at the zero bound at the short end. We have potential for global growth and U.S. growth to recover next year. And then, of course, we have this potential for stimulus, not only fiscal stimulus coming in terms of COVID relief, but also potentially from areas like infrastructure package from the Biden-Harris administration next year. And so, when you put all those together, you could see inflation expectations start to rise. Now, to your point, it's a show me story to some extent, and thus far we haven't been seeing any of those signs of inflation, and we'll get some interesting data tomorrow as well. But I think generally what bond yields are telling us is that the probability of inflation expectations rising over the next 12 months is also rising. And I think, keep in mind, prior to the crisis, the 10-year was at 1.5%. We fell to about 50 basis points. Now we're recovered to about 1%, slightly under on the 10-year. Could we start heading back to those pre-crisis levels of maybe 1.25%, 1.5% over the next 12-month period? It's something to watch, particularly as these ingredients start to come together, driven by the vaccine, the global recovery, low rates, and then stimulus added to the system. So I think that's a recipe for potential inflation.
If that potential for inflation is there, Mona, should it make investors dubious about some of the lofty valuations we have, either in the equity market or in the corporate bond market? If we look at the chart we had up a moment ago, I mean, we've got the corporate bond market back near highs in price. You've got spreads that have tightened to the most kind of optimistic levels we've seen throughout this virus period. For corporate bonds in particular, is there any inflation risk being priced in here, or are they ignoring that possibility right now?
Yeah, there's certainly a bit of complacency right now in the markets, and we're seeing it both in equities and in bonds. You're also seeing it in the VIX, for example, back to pre-crisis or certainly the lowest level of this crisis.
Yeah.
The VIX back at 21 levels, and that's considered in some ways a fear indicator. And so there's a little bit of I think optimism in some ways in the markets, and I think that's natural given that we are emerging out of this global pandemic and we have some hope on the horizon that perhaps we have some strong solutions in place. And so I think markets to some extent are reacting naturally. But to your point, I do think the question will become, if we start to see growth, outsized growth, economic growth, especially in the second half of next year, does that bring the Fed back to the table, for example? Do they start thinking about, what their next rate moves will be, or do they need to keep rates at the zero bound? Keep in mind, they've already told us that they're willing to accept inflation running above their 2% core PCE target for an extended period of time. So to some extent, 2021 may be shielded from any Fed moves, at least. And so perhaps, you're looking at a period where you still will get this low rate environment with global growth recovering, and that's a good backdrop for risk assets broadly. And so I think markets are thinking about that to some extent over the next 12 months. Now, once we get beyond 2021, you do have to start thinking about maybe normalizing this scenario a little bit. How do we think about bringing rates, gradually back up to more normalized levels, bringing maybe yields back up a little bit to more normalized levels? And that does have impacts, especially for longer duration assets and even, sectors like technology, which tend to be longer duration as well and do better in a lower rate environment. All this being said, even if we do come up another 50 basis points or so relative to a longer term history, it's still a pretty sanguine or benign environment for rates.
Mona, one other point here. On Friday, we had a pretty interesting event where headline for employment came in ostensibly soft, but we actually had bond yields climb. And actually, if you look also at some of the Fed funds, there was a slight tick up in the possibility that these rate hikes might actually get pushed forward a little bit. If you look at bonds on the shorter end of the curve, if we get through this winter COVID wave without another double dip in the economy, are we going to have to accelerate our rate hike timeline?
It's a little early to say because, like I said, if we don't see inflation well above 2% in the core PCE for an extended period of time, then I think a rate hike is probably not on the table. But to your point, when the unemployment numbers came out soft and rates moved up, that was a clear indication that markets were expecting more stimulus added to the system. And so when you kind of flood the economy with stimulus, you will see inflationary pressures build, you will see yields move upwards, and that's exactly what happened. And so, whenever we do see that combination, I think the reaction in the markets, will be to start to think about that future of higher inflation and higher yields. When the Fed will actually move, I think we'll have a better sense as we head towards the second half of next year, and we see not only where inflation is, but if global growth truly has recovered to pre-crisis levels, and perhaps we're heading towards even stronger levels as consumer behavior really comes to the forefront, and people start really booking their travel and going shopping again, et cetera, et cetera. And so we really could get some interesting ingredients in place in that second half of next year. So something to watch at that point. And I think before that, it's a little premature to think about Fed rate hikes.